course, we're talking about those GDP figures. You warned us yesterday that they were going to be really bad. So it's not necessarily unexpected, but it's still crushing, isn't it?
It really is, Sally, and it just shows us the work that we need to do to get the economy back on its feet. So that 51% contraction in the second quarter comes as no surprise, as we've just mentioned. It was expected. The global lockdown halted economic activity. Japan's economy shrank by 28% in the second quarter of this year. China, the first to be hit by COVID-19, shrank by 3.2% in the first quarter. But South Africa had been in a recession before COVID-19 hit, and of course the industry-wide shutdowns between April and June only worsened the situation. Let's bring in economist Sifiso Skenjana to the conversation to just discuss this a little bit further. So as I've just mentioned there, it wasn't really a surprise what we saw in terms of the contraction of 51%, multiple sectors in the negative. So how do we read these numbers given that we had the complication of COVID-19 also having a major impact?
It's important for us to understand how the numbers are reported, and so you often see words like annualized and seasonally adjusted, and also then purely just quarter on quarter. And so what we are seeing, for example, 51% is an annualized number, and that number speaks and say, if we were to continue in essence at this rate, the economy would contract for the year at 51%. And so when you look at this quarter compared to the last quarter, that's a 16.4% contraction. But I think it is important that we are able to look at annualized numbers because it gives us a sense of what would happen if things stay the same, and also enables us to have a comparable view of previous terms and previous seasons numbers. I think over and above that, then saying, well, what must we see in these numbers? I think the first thing we ought to see is the construction number. Construction is in its eighth quarter of consecutive negative growth, and that's really scary. And that's also one of the sectors that has a high employment multiplier and is able to employ relatively unskilled and semi-skilled labor. I think the other conversation that we have to see through these numbers is when you're seeing a contraction in manufacturing and trade, and that's literally been, over the last 25 years, manufacturing has gone down from about 28% of GDP to now about 11% of GDP. And that means we've lost productive capacity in the economy. And that's the thing that's truly going to inform how we're able to get back onto a sustainable growth path.
And I'm glad you bring up important sectors like manufacturing, because what we're thinking here is, as you say, there are big job creators here. How do we, or when do we start to seeing them switch and start becoming sectors that are creating or absorbing jobs in the country once again?
We've got to make the right investment choices. I've always said that our skills planning's got to be tightly aligned with our economic planning and then our investment planning. And so there's something that we call the revealed comparative advantage. And really what it speaks to is what goods are you able to produce in a globally competitive market space that at a relatively lower opportunity cost relative to other economies. And those are the goods that enable you to remain globally competitive. So we've got numbers that show us which sectors we've got high RCAs on, and those are the sectors that we've got to ensure that become our ticket to playing in this globally intensifying marketplace and ensure that we are putting our money where we actually can compete effectively. The other sectors where we have to is that we must also look at sectors that we know we can't operate without. And so when we saw that pre-COVID, that 3 countries dominated 68% of the medical goods manufacturing, and as soon as borders closed, you saw the pressure that it had and, of course, the economic pressure. And so the certain capacity that you need to have in your local economy. And one of the other things that, again, will inform how we're able to turn this thing around is how we look at import intensity. And so that's a number that looks at number of goods we've got to import just to sustain domestic demand. That's been increasing over time, and particularly at the sectors that are labor-intensive sectors, which means in the labor-intensive sectors in the economy, we have not gained any competitive in a global context. And those are the sectors we've got to focus on in trying to rebuild this economy.
One of the big things we talk about also is the impact that this is going to have on our fiscal health. No doubt government is going to face continued pressure to provide relief probably for the rest of the year, given what we're seeing.
Absolutely. And so, of course, our borrowing program is clearly going to accelerate on the back end of this. And I think one of the other questions we haven't asked is how do we create a broad base of middle and small sized businesses in South Africa? We've got some of the highest Herfindahl indices in the world. Herfindahl index is the measure of industry concentration. And as soon as you've got industry concentration, it means that small businesses can't play in that space. Medium-sized businesses can't play. And one of the examples I recently used, I said, we could actually leverage the procurement process as a means to drive small and medium-sized business development, where you ensure that there is an investment portion of the payouts that's held back to ensure these companies can get back, can play in larger supply chains and value chains. And so there are ways in which we can build capacity in the economy in a budget neutral way. And I think we've got to make sure that we are able to take advantage of those levers to ensure that we can get back onto a growth path.
So much to discuss, so little time, Sifiso. Thank you so much. That's Sifiso Skenjana, who's the chief economist, who was breaking down those dire economic numbers that we saw coming out this morning.